In the past, when the market falls 15%, or the market falls 20% or 30%, the risk of loss over the next 12 months actually are lower, not higher, actually lower. To justify the massive expenditures here, you need to show broad enterprise adoption and really good ROIs. And I think we're just early in that case to be made about how that's going to play out. So could this be as impactful as the railroads or internet? Absolutely. Maybe even more powerful. But I think it's still to be determined how powerful that is. The S&P 500 of today is vastly different from the S&P 500 of 2006, and very, very different from the market in 2011. In 2006, 45% of the earnings from the market were coming from financials, materials, and oil. And those are all low multiple sectors, right? Today, we have actually 53% of the S&P 500 today, from a market cap perspective, are businesses that are actually growing organically in the high single digits, basically twice nominal GDP.
Hi, David. Welcome back to Excess Returns.
Thank you for having me. A pleasure. I'm looking forward to the conversation today.
We had a great conversation with you last year. I know our audience really enjoyed it. And so some of this discussion today is a continuation of that, but we wanted to cover many new topics with you as well. You lead T. Rowe Price's capital appreciation strategy, including the Capital Appreciation Fund and Capital Appreciation Equity ETF. You also serve as the head of investment strategy and CIO for the firm. So the cool thing with you is we can talk bottoms up investment selection, stock selection, and the things that you're doing in fixed income, but then we can also talk strategic stuff with you as well. So that's why these conversations are really meaningful, because you bring sort of this bottoms and top down perspective. So that's going to be great. So thank you very much again for joining us.
Looking forward to the conversation again. This should be fun.
One of the ideas that you talked about when we first sat down last year was this idea of exploiting structural inefficiencies sort of in the market and in your career. And you had given the example of GARP stocks having like no, natural owners. They don't sit in value. They don't sit in growth. But can you just explain the process that you think through when you're trying to identify those types of structural inefficiencies?
Sure. I think there's a lot of different ways that we would attack that question of these structural inefficiencies. There's usually some kind of cause for that inefficiency to exist. Not only exist, but persist in the future. So when we've talked about GARP in the past, one of the structural inefficiencies is the value manager who has all these banks and insurance companies and secondary insurance companies in their index. They'll look at a GARP stock at 18 or 19 times earnings, and they'll say, that's too expensive. So that they won't be interested in buying that. A growth manager on the other side of the table might say, I'm only going to buy companies that have double-digit top-line growth, right? And a lot of these GARP stocks don't have that. So there's not retail investors don't know about these companies. They don't know about a AJ Gallagher or a Revity. They just don't know those companies well. So and then it's not a hedge fund name because the stocks don't move a lot on quarters. So there's no natural buyer. So what you've been able to buy historically within GARP stocks, you've been able to buy companies that grow earnings, let's say 3-4 points faster than the market over time, with much lower earnings volatility, much lower downside risk, for a premium to the market that is very, very small, in some cases almost nothing today. So I think that's kind of the inefficiencies we're looking for. In high yield and leveraged loans, the most attractive part of the high yield universe is double Bs. Why is that? Because there's very, very low default rate, but you're earning 100 basis points higher than what you would get in investment grade by buying there. And part of the issue is, if you're a high yield manager, you can't be overweight double Bs because they have a yield lower their index. But since we're not focused on the high yield index, we're going to buy a whole bunch of double Bs, earn that 100 bips a higher yield, not taking any really default risk, and exploit that inefficiency. So we're going there's always usually a reason, something substantive, something that is persistent, that exists, that allows us to exploit these inefficiencies.
I'm just curious, do you find that when like a value stock is kind of starting to migrate into that GARP-y sort of environment in that area, a value manager might look at it and say, wow, this is getting expensive. I don't want it anymore. But I would think some of the great performance from that value migration into GARP could actually happen, which is what you would be getting sort of exposure to there.
No, I think it's a great point. I mean, I think if you take a step back, you go back to, let's call it 2010, 2011, I think you would have said a Thermo Fisher, which was growing about 3% at the time. You would have said a Pfizer, which was growing 2% at the time. I think most people would have said those were kind of more value stocks, right? And then over a period of time, as their top line growth inflected from low single digits to mid single digits, or even in some cases high single digits, the multiple in those stocks went from a low teens multiple to, in some cases, a mid to high teens multiple, in some cases a low to mid 20s multiples. And those were stocks that kind of compounded wealth over a decade in the mid to high teens and were huge value creators. So I think you're absolutely right. There is a possibility of a transition from with a good management team that does good things with capital allocation, can also the composition of the portfolio, to go from that value bucket to a GARP bucket and get not only faster earnings growth, but multiple expansion. And that's where you can kind of get that double winner of, again, multiple expansion, faster earnings growth, where you can get these kind of mid-teens to high teens kind of total shareholder return over a decade or more, and they can really massively drive outperformance of any kind of strategy.
You're not known as this, person that is making huge market timing calls. You're a long-term investor. You've managed a capital appreciation fund for a very long time with an excellent track record. But when we had you on last year, you did explain to us that after the sell-off for the tariffs, you were strategically adding equity exposure, and that was actually ended up being a good, I think, outcome for you guys. And I'm just wondering if you could just explain the thought process and sort of the framework that you go through when you are sort of moving the equity exposure and the fixed income exposure up and down.
I think this is just based on our view of history. I think if we look at history and we say in the past, when the market falls 15% or the market falls 20% or 30%, the risk of loss over the next 12 months actually are lower, not higher, actually lower. The expected return goes from, let's call it 10% per year to a 15 or 20% return. When vol spikes, well, it drives the stock market down in the short term. It's usually a very good positive indicator for 12-month forward returns or 24-month forward returns. So what you found over time is that what we've done, I think we've done a very good job at it. We did it in April. We bought $4 billion of equities in a 3-day period of time in the April swoon. We bought $7 billion of equities back in the in the COVID downturn, on the last couple of days of that downturn. So I think we actually have done a pretty good job when the market goes down, when everybody else has fear, when everybody else is calling for recessions, when everybody else is de-risking, when everybody else is adding to cash, we add risk. Not because we're just naturally contrarian, but because we know, based on history, when vol spikes, insider buying accelerates, markets are down, the risk reward of buying stocks at that moment, even if it doesn't feel good at that moment, are incredible. And I think in the course of my 19 years running the cap appreciation strategy, almost 20 years now, we've probably done that 10 times with a hit rate of basically 100%. And again, the next time we have a downturn of 10, 15, 20, 30%, we'll do the same thing.
Yeah, but that's so, as a professional, you're disciplined, you do it, but, individual investors, it's so hard, when the market's falling, the negative headlines are out there, and that's what, what's being paraded around is, we're going into the next bear market, it's going to be deeper, whatever it is to get the fear levels high. And so I think the point here is, seeing through that is, I think, very important for long-term success.
I think try to focus on, for individual investor, the next 12 months of return, not trying to optimize what makes you feel good in the moment. What's going to work for tomorrow, next week, next month? No, that there's a lot of uncertainty. But I think it's a great point that, there's a reason why this happens every time. There's a reason why the market fell 19% in April. There's just a lot of fear, a lot of concern. Markets are going, stocks going down, but stocks going down is actually is a good thing. It means forward returns are greater. The risk of loss is lower. And so I think that's we talked about you asked a really good question earlier in the discussion around market inefficiencies. This is one of the greatest market inefficiencies. That when the market is high, investors feel like, yeah, things are great. Valuations are expensive. Things feel great. But actually, your risk-adjusted returns in that point, next 12 months, next 24 months, aren't great. But almost counterintuitively, when the market's down 20%, 30%, 35%, 15%, your actually forward return expectations at that point are much higher. So what you will see over time is when markets are frothy, expensive, you will see us pull back our equity exposure. And when markets are cheap, when there's fear in the marketplace, you will see us add to risk assets. And then over a full cycle, we'll probably neutral risk assets. But that over the course of my career, that 19, almost 20-year career, that's created a lot of value for our clients, doing, zigging when the market's zagging and vice versa.
And how do you view, I mean, there's an argument right now that even though the Mag 7, not all of them have produced great returns or are trading at the valuations maybe they were at their peak, but generally people would say the market looks kind of expensive here when you look at something like the Shiller PE or maybe its current PE ratio. So what is your current take on the market's valuation today? And is there anything about like the headline PE that you would sort of push back on?
Sure. I would just correct you on one thing, Justin. I refuse to say the Mag 7.
Okay.
We'll talk about the Mag 6, but let's just be honest. Tesla is losing market share in every region. Their profit expectations over the last 3 years are down 75%. If we're going to put Tesla in the Mag 7, we should put GM or Comcast or Ford in the Mag 7, or because they don't deserve to be in the Mag 7. They are very overvalued. So I'll just maybe make that one point. So I always refer to the Mag 6. But to get to the heart of your question, in all honesty, one of the things I think the market, a lot of people are very, very lazy when they look at the market. They're lazy in that the market is a living, breathing entity. The S&P 500 of today is vastly different from the S&P 500 of 2006, and very, very different from the market in 2011. In 2006, 45% of the earnings from the market were coming from financials, materials, and oil. And those are all low multiple sectors, right? Today, we have actually 53% of the S&P 500 today, from a market cap perspective, are businesses that are actually growing organically in the high single digits, basically twice nominal GDP. So, what the S&P 500 is a culmination of 500 different companies, all with different growth rates, all different fundamentals, all different multiples. One of the things we do as a team once a year, we go through every company in the market. We look at their growth rate, we look at where they traded historically. We project out 5-6 years forward. We come up with a multiple, what the market, what those companies should trade. Then we aggregate it all up. We do some we basically do a micro analysis of 500 companies in the market and say, what is the fair value on the market by doing all this aggregation analysis at the micro level, right? It's surprising to me, very, very few people do that. I think a lot of people are just honestly very, very lazy when they approach this question. Just look at history. But again, it's a very, very different market today than it was 10, 15, 20 years ago. So when we do that analysis, we say, what is the right multiple for the market at the end of 2031? And the bottoms-up analysis we get is about 19 to 19.5 times earnings. And again, that is just mix. Tesla wasn't on the index 5 years ago. Palantir was in the index a couple of years ago, right? Financials are a much bigger part of the index. Energy is a very small part of the index. Utilities are becoming much, much faster growth companies than they used to be. You have to adjust for all of that at the micro level. It's a lot of work. It's literally about a couple of weeks, two-month process we go through, but it yields great insights on the market. It yields great insights in trying to find really great opportunities in the marketplace by doing that 500 company micro analysis. So when people say the market's expensive at X, I think that may be true. And the market is expensive today relative to where it should trade, but it's not based on where it used to trade 10 years ago, or 15 years ago, 20 years ago. That's not a very good comparison from my perspective.
Can you share that report with me when you guys produce it? I'm just kidding. I'd love to see it, but I think that's proprietary.
It is a little proprietary.
To your point about the changing composition of the market, one of the things you see people who are bearish on the market constantly talking about is the idea that profit margins are a mean reverting series and that profit margins have to come back down. I mean, do you think that's wrong? I mean, given the nature of the market, I mean, do you think we're just going to continue to see at a market-wide level expanding profit margins?
I think most of the recent profit margins are where they are today, is just mix. You know, NVIDIA has 70% operating margins. And again, maybe those margins won't always be 70% operating margins, but they're a very large part of the index. You know, Apple used to have very, very little services business. Today, services is over basically about half of the profits of Apple. Their service margins are very, very high. It's just there are these mixed elements that go into it, right? You would normally think of energy kind of being kind of a low margin sector, materials being a low margin sector, parts of financials kind of being a low margin sector. And they're just a smaller part of the index. So I think again, you know, I would argue that profit margins are not necessarily mean reverting at an index level when you adjust for mix. Again, that would not be something that I would get concerned about from my. Now there are certain companies in the marketplace that again, maybe NVIDIA is over earning. We'll maybe talk about AI a little bit later. I think one of the challenges NVIDIA might have is NVIDIA has been the only game in town for GPUs, and that is changing. That is changing with AMD's has a really great product coming into Q3, Q4 this year. We see the TPU success at Google. There's going to be more competition, and the economic rents that NVIDIA is probably getting today may not be able to sustain 70% monopolistic operating margins in the future. And but that is a firm-specific comment. That could influence that, and that will, as we do our analysis, that will come across. But I don't think that is a cause for concern when you adjust for mix. I think that again, I would argue that is a little bit of a lazy analysis.
One of the interesting things I found when I was prepping for this, and you mentioned before your bottom-up work on all 500 companies, is a lot of people talk about the Mag 7 as expensive, but I think you see maybe below them in the large cap space, maybe a lot more overvaluation and names people might not expect. So can you talk about that?
I think what's really interesting to me today is that, you look at, if you think about, I could come out Goldman Sachs, and this will be a good year for M&A, it'll be good for trading, it'll be a good year for equity issuance, it'll be good for IPOs. But I think in the course of my career, I've probably bought Goldman Sachs 5 times, and you can you buy it at 1.1 times tangible book when people hate it, and you sell it at 1.8 times tangible book when people love it, and you rinse and repeat. And there's probably hundred companies we've done that multiple times over the course of my investment career. And today, Goldman Sachs trades for 3 times tangible book value, which implies a long-term ROE of 30%, which no one really believes. And I think what's interesting is you think about whether it be financials, some parts of consumer discretionary, Walmart trading at kind of these almost 40 times earnings, Costco trade for 45 times earnings. For companies that are, let's call it high single-digit EPS growth companies, low double-digit EPS growth companies, again, that doesn't really make a lot. Or even industrials. It was interesting the other day just spending time looking at Caterpillar. Caterpillar's average about 17 times multiple over time. Today, it's trading for 29 times. It's actually trading for 22 times 2029 for a very, very cyclical company with, at best, mid-single digit kind of organic growth. So I think what's interesting to me is in the marketplace today, again, we can debate. I think Tesla does not deserve to be in the Mag 6, Mag 7. I don't put it in the Mag 7. A lot of the other names in the Mag 6 are not expensive. I think the most overvalued part of the market today is like industrials, which are trading at just ridiculous valuations versus history. And I don't think their growth rates are vastly different what they've been in the past. In many cases, because we had that massive inflationary environment, which elevated their growth, their EPS. I think it's unlikely, most industrials grow earnings at a double-digit clip over the next 5 years, and yet they trade for big premiums to the market. Financials, banks trade for very, very high valuations. Parts of consumer discretionary, even parts of consumer staples trade for very high valuations. So when we do this 500 company analysis, when we do this micro analysis of the whole market, what's really interesting to me is the market returns are only expected to be like 6% in the next 5 years, but there are companies, non-pharma healthcare, we can talk, software, utilities, where you would look at this and you would say, I think I'm going to generate returns buying these stocks today anywhere from low teens to low 20s IRRs next 5 years. And then you look at, industrials or personal consumer discretionary or financials, you say, well, you know what, those returns are likely to be kind of in the low single digits or even negatives in some cases. So I don't know if in my whole career I've ever seen such a dichotomy in the market in the expected returns, where the market just really wants to own beta today. The market just wants to own beta and doesn't really care about valuations. And again, I don't think we've ever really seen this dynamic ever before in my career, this dislocation between parts of the market and other parts of the market, expected returns being, again, in some cases, deltas of 1,500 basis points over a 5-year basis. So.
You mentioned AI before, and I was interested to talk to you because I love talking to people who are managing actual portfolios as we go through this technological revolution. Like, I just want to start at a high level. Like, how are you thinking about AI? I mean, do you think about it relative to railroads and relative to the internet and other technological revolutions? Like, how are you thinking about AI in general?
I would say it is a TBD a little bit. And I think anybody who tells you, Jack, that they know exactly how AI is going to play out is fooling themselves. I think we know a certain thing. We know a lot of things, right? We know that coding works. We know coding works. It is great ROI. It helps write software, it just works. We know that consumers are using ChatGPT, using Claude, using Gemini, and really having great results. We know it works for marketing. We know it works for targeting ads to show you or your family from a meta perspective. We know there's some great use cases, right? But we don't. The question really is: are the use cases for there's this $40 billion white collar worker TAM? Do we really start to get? Does the productivity, does the accuracy get to a point where we just start replacing a lot of white collar labor with AI, with software, right? And I think the evidence so far is to be determined, right? I think most people who use Copilot from Microsoft right now would say that is a very, very marginal benefit. And so we will see if that changes over the next couple of years. I think that is, I think there are certain applications we are seeing a clear substitution of labor for software, for AI. But to justify the massive expenditures here, you need to show broad enterprise adoption and really good ROIs. And I think we're just early in that case to be made about how that's going to play out. So could this be as impactful as the railroads or internet? Absolutely. Maybe even more powerful. But I think it's still to be determined how powerful that is. Because I think there are things that AI is really good at, and there's things that AI will struggle with, even within software. Right? There are one of the experts we've talked with. He made a very good point to me. He said, if you are just trying to get a good answer, AI is usually going to be pretty good. Like if I ask you to draw a picture or create an ad with a man or a woman in that ad, and you want to describe that person, there's multiple right. There's not one right answer, right? But if you want to determine what my earnings were for this quarter at T. Price, or you want to figure out what Microsoft earned this quarter, you're not. AI is never going to be 100% accurate. That's just not what AI is good at. You're never going to replace an ERP system. You're never going to replace a Workday. You're never going to replace an SAP with an AI solution, because it's just never going to be. In those situations, you need the answer to be 100% accurate. It's just not what AI is good at. But could AI replace what Adobe does? Absolutely, completely. Adobe could go away. Could it replace parts of what Salesforce does on the marketing side? Absolutely. Is it going to replace SAP? Absolutely not. Is it going to replace Microsoft? Absolutely not. Is it going to impact? Is it going to take impact Workday? Absolutely not. Is it going to impact ERP systems? Absolutely not. Right. But there are a lot of other use cases where it could. And I think what we're trying to do in this environment where the market is selling everything that is, tied to health, to software in particular, where are those deserved? Where is that a real risk, and where is it not a real risk? And as the market kind of throws the baby out with the bathwater, are some really great opportunities in software for us to take advantage of. And maybe the last thing I would just say on software or on AI, I think the most important thing probably for your viewers or people who are listening to this today is I think it's a really important point is that what Anthropic, we're private investors in Anthropic. I think hopefully that'll be a very good investment for us over time. Maybe even I think Anthropic will end up being bigger than OpenAI over time. Is that they've basically proven that if you have enough engineering talent, if you have enough time, you have enough just really smart people, you don't, that NVIDIA moat is not that important. You can basically put an orchestration layer and find what applications work best with NVIDIA, what works best with AMD, what works best with custom silicon, works with Trainium TPUs. And I think what's interesting as we talk with experts, as we talk with companies, we are at an inflection point where I think this moat that NVIDIA has today, where they're going to have 93, 94% dollar share of all the GPUs, that's going lower. And again, going back to the earlier comment about margins, in a world when you have no competitors to having multiple competitors, there's probably going to be some margin pressure, some share pressure. Doesn't mean it can't be a fine stock because the valuations come in a lot. 26 is still going to be a very, very good year. But I think you should look at 27, 2029. I think more and more companies are kind of going down the Anthropic model. And again, what Anthropic's proven is we can produce basically the best LLM in the world without spending the majority of our cash flows on NVIDIA devices. We are using some, but we don't have to use NVIDIA exclusively. And actually, I think in many cases today, the Anthropic, the minority of what they're doing today is on AMD. And we're hearing that more and more from other companies. And that benefits Broadcom. It manufacturers of TPUs, that benefits AMD, and the second kind of solution in the marketplace, and probably over time benefits the cloud providers as well. They can earn more rent. That there's going to be a rent redistribution that's going to play out the next 5 years. Again, maybe not next quarter, not next week, not next year or this year, but I think if you have a 5-year view, I think NVIDIA's market share goes a lot lower and probably their margins come under some pressure.
In terms of the less obvious tech plays in your portfolio, is this something where you're going through every position you have and saying, how does AI affect this? Like, is that how you think through this?
Absolutely. That is, where is disruption risk real? Where is disruption risk and the stuff? Where's there a disconnect between what the perception of disruption risk is? I mean, it was funny yesterday. You saw, again, Anthropic came out with some solutions that were more legal in nature that could potentially impact the legal market, and you saw a whole bunch of index companies, whether it be LSE, the exchange, the stock exchange. You saw S&P Global, all come under a lot of pressure. Some of that pressure was probably tied to some changes the administration had made with regard to mortgage fees that impacted Equifax. There was some Gartner had a really bad kind of non-AI related quarter, but there was a lot of pressure, and these are companies that really have proprietary data sets that should not be any way impacted by AI. Yet these stocks were all down 10% plus and trading at not trading more very, very reasonable value. I think that's kind of just silly. Again, one of the things we do, and I think one of the things that makes me feel better sometimes, whenever we go through a period of time like we have these events where the market just throws the baby out with the bathwater, is we do due diligence, right? And I'm not going to mention the software company that we had this. We talked to one of their largest their customers of a large software investment we had, and the customers, the stock's probably down 20%, 30% because of AI concerns, and they looked at us and they said, "You do know, because of AI, we're going to spend more money with this company, not less. These company actually becomes more valuable to us in an AI world today than it did in a non-AI world." And so you have this disconnect that just builds confidence. Like, okay, markets thinks this is a concern. One of the largest customers telling this we're going to spend more money. Let's push that bet. Let's get more aggressive. Let's not listen to what the market's doing, where the market's panicking. Let's make really good investments with that 5-year time horizon, and distinguish between where this is a reality. Again, Adobe, this is a reality. This could really impact Adobe's business. HubSpot could really impact their business, right? Some small cap software companies and Intuit, this could really impact their business, but it's not going to impact PTC, Workday, SAP. It's just not. In many cases, these organizations will be benefited by AI, and so we have to use this period of uncertainty to take advantage of these opportunities by taking a little longer time horizon, by doing really good due diligence, talking to customers, and making sure we're right on these things.
Do you have any thoughts on the changing nature of, I'll catch myself here and saying Mag 6 instead of Mag 7. But do you have any thoughts on the changing nature of those businesses? I mean, what made those businesses great in some ways was they were very asset-light companies. They had high free cash flow, and now they don't look like that anymore. And I think a lot of investors are trying to figure out how to make sense of that. Are these like permanently changed businesses where what made them great's not there anymore? Like, do you have any thoughts in general about that?
I think it's a very good question. And again, and actually it goes back to, I think, a point you raised earlier about valuations. I think if you want to make a bull case for the Mag 6, you would say that the valuations are actually very, very reasonable relative to the market, relative to the growth rates. And if you want to make a bearish case on those, you would say, well, to your point, good point, they're spending a lot of CapEx today, so their free cash conversions, so their multiple on free cash flow is a little bit less attractive. I think, again, what I would tell you today is that there's a question mark about the forward returns about all this CapEx investment, right? Again, what we've seen so far in the first 2 years, we have not seen profit margins for Azure, for AWS, even for Google Cloud come down, right? So we're spending a lot of money on CapEx, and yet the returns they're getting on incremental investments are going higher right now. I would also say there is a little bit of a timing aspect of this, right? So the way you build data centers is you got to go and buy land first, right? Then you got to build a shell. And that land doesn't really depreciate, right? You buy land, it doesn't depreciate. So, the return you get on that investment initially is very, very low because you buy land, then you got to put a shell on top of it, and then you put on the short cycle GPUs, the network, all that other stuff where you are going to run a return. But return, you would make an argument that the free cash flow right now is a little bit depressed because you've forward spent CapEx that you're not earning a return on that you will earn a return on in the future. So I think these companies have become more capital intensive. I think we are probably getting to a point now that return on free cash flow equation as the mix of long cycle capital, which has a low return initially, but a good return over a longer time, and the mix of kind of short cycle capital where you earn a return almost immediately. That mix, which has normally been, let's call it 50-50, last couple of years, it's been like 75-25, probably gets back to that 50-50 over time, or even kind of 40-60, and you start getting higher returns on free cash flow going forward. You just get better utilization of that CapEx. So again, probably a little bit structurally lower free cash flow, very fair point. But I also think there are other aspects of the cloud business. One of the interesting things with the cloud business, you think about the non-AI cloud business, we are seeing that enterprises are accelerating their movement to the cloud because they know if I want to take advantage of AI, I have to have more of my data in the cloud. So we are seeing non-AI workloads accelerate to the cloud today, right? That was kind of going at, let's call it, a 1 to 2 point increase in the percentage of workloads that are in the cloud to not in the every transition every year. And now that's kind of going by 3 to 4 points a year. So the non-AI related workloads, where you actually get very high returns on capital, very high ROI, that part of the business is actually growing faster than it would have been otherwise. So that's also cushioning some of the headwind we're seeing on slightly lower ROI on cloud today.
Do you think the biggest beneficiaries here will be downstream of the people that are doing the build out? Like if you look at the internet, that obviously was the case. The companies that built it out were not the biggest beneficiaries. But here I could argue, this is intelligence. This is maybe a different thing. I mean, do you think we're still going to see a situation where the biggest beneficiaries will sit downstream of the companies that are building this out?
I think it's a great question. I think you're going to see benefits most likely everywhere. Again, this goes back to the point I raised earlier. We're just not, it's still very early. Even though we're 2+ years into this AI cycle and we're spending hundreds of millions of dollars on GPUs, we're still not exactly sure how this is going to play out, right? We have yet to see a model that is trained on a Blackwell or MI450 kind of. We really, all these models have still been trained on older generation block. We still haven't seen what an LLM is kind of capable of after it's been trained on a Blackwell or an MI450 kind of model. So we still don't know necessarily how big the benefits are. But I think if to the extent that this drives increased productivity, that you can actually reduce human labor and substitute lower cost software, that could benefit most companies that have a lot of white collar work in the labor force. Again, I'd go back to software. Some software companies probably have the largest percentage of people who are doing coding. If you can get rid of some of those coders, your margins can go a lot higher over time, and you can add on additional AI work add-ons, if you will, that could actually benefit software companies over time. Again, that's not. No one's really talked about it today, but I think over a multi-year period of time, that could be a benefit. You can get the margin benefit from less coders, and also margin, top line benefit from more AI add-ons there. So yeah, but it's still TBD. Again, I would argue right now some of the biggest beneficiaries of AI will be probably a Broadcom, an Amphenol, a AMD, the utility companies that are really helping facilitate a lot of this build out, and especially the regulated utilities. I think they're very, very well positioned to benefit from this. And again, it's too to be determined. So when we do our 500 company models, we are not building in massive margin expansion based on AI over the next 5 years into any of those. That could be an upside. That could be an upside to your point. Do we wake up in 5 years and the unemployment rate is structurally gone from 4 to 5.5, and the profit margins for the S&P 500 are 150 bips higher than they would have otherwise have been? That is an upside case that would accrue to everybody in the ecosystem, or most companies in the ecosystem that have a large white collar workforce.
Are you seeing benefits from this as an investment manager? Like on one hand, I would think if you're doing 500 bottom-up analysis, this could help, but I would also think your analysts are probably still better than this. So like, are you seeing benefits in terms of that type of work?
I think it is. I think it is. There is productivity, but it goes, when we use a variety of different AI tools. Again, I use Claude through Anthropic, which is actually the best. And we use Perplexity, and there's some these service called AlphaSense. And I think what it does make us more productive, right? When we would go back to April of last year when there was all the uncertainty around tariffs, I had to do a deep dive on tariff law. I had to figure out what is IEEPA, right? And that probably would have taken me 3 or 4 days to do. But in a world with Claude, a world with Perplexity, to be able to say, this is what I'm looking for, give me all the relevant history of IEEPA, why was it in place, what are the courts said, what are all the, why will this be upheld, not upheld? Yeah, I was able to do that in a day and get a note out to the rest of the firm talking about how I thought IEEPA would be overruled. And I had a high probability of that based on all that work. Now, that would have taken me 3 days, to me a day. If I want to find a email that one of my other co-PMs has sent me, I can find that almost instantaneously using these services, right? If I want to, read everything that's ever been written in the last couple of years in any different source on a certain drug, I can do that. So it does increase our productivity, but does it? So on the margin, does it make it easier for us to do that 500 company analysis? Yes, but I don't think AI is fundamentally changing how we invest. I don't think it is fundamentally changing the number of people we need at T. Rowe Price. I think on the margin, it just makes it a little more productive, but I don't think it. We're not ready to turn over the portfolio to AI just yet.
You mentioned lazy analysis before, and I think one of the lazy analysis people do is they just look at the dot-com bubble and they look at today. They say, we've got a technological revolution. The market's up a lot. We're going to see the same exact thing again. And you've talked about how there's some big differences between that and now. So I'm wondering if you could just talk about that. Like, what are you seeing different now than you saw back then?
Oh, yeah, I think it's a great question. So what was interesting is if you go back to the dot-com bubble, that was a situation where those were, if you look at the value, I think the number is that, I think Cisco may have peaked out at 500 times earnings. I think AOL peaked out at over 100 times earnings. I think EMC may have hit 1,000 times earnings. You just saw extremely high multiples based on really a lot of hope. And there was also, again, there was so it was actually a very small part of the earnings for the market were coming from tech at the time. I think the tech sector peaked out at like $8 EPS. If I go back to like that year, the peak year, I think the market was going to earn like $60. It was like 15% of the market. And then in the downturn, it went from $8 to $1 in the tech sector because a lot of those earnings just went away. And I think if you look at today, you don't see the same kind of crazy valuation. I think that would feel a lot different if NVIDIA was trading at 200 times earnings, or if you said, but a lot of the tech earnings today really have very, very little to do with AI, right? Apple's earnings today, they really don't have anything related to AI, right? AI can go away tomorrow, and Apple's earnings wouldn't be affected at all, right? Microsoft, again, there's a lot of growth built into Azure in the future, but I think there's also that's still a very small minority of their revenue comes from AI today, right? Now that again, NVIDIA is different. Clearly, if the use cases for AI do not develop, if the LLMs commoditize more than we think they're going to commoditize, NVIDIA's earnings could clearly collapse. That is absolutely true. But NVIDIA is still a relatively small part of the S&P 500. I think their earnings are like 5 or 6% of the S&P 500 today. So you don't have a situation where, I think tech earnings would collapse in that situation. Again, software earnings aren't going to collapse. Most, Apple's earnings aren't going to collapse. Google has this very, very profitable search business that wouldn't collapse. So there's just a lot more recurring revenue today. So, I think it's very, very different. Valuation then is high, and it's not all being driven by the same factors. It's not all being driven by some kind of networking cycle or telecom cycle like it was back then. I think you would not see tech earnings fall 85% like you did last time, because it's just so much of the earnings are more software, recurring. Meta has negative earnings coming from AI today, probably given all the spending they're doing today.
Yeah, you mentioned Apple and Meta, and it's interesting to me contrast what they're both doing right now, because it seems like Apple's idea is we're going to let other people build this out and we're going to take advantage of it, and Meta is probably spending the most money on CapEx. Do you have any thought about the balance between those two things?
And I think it's actually, again, I think it's a very good observation. In all honesty, what I would tell you is, again, I think Apple understands what they're good at, and I think Apple understands that our probability of being successful in creating the greatest LLM is probably somewhat limited, right? And why don't we just partner with Anthropic or partner with ChatGPT or Gemini or whoever and build those applications and get some kind of rent on that from the services perspective, right? I think we don't need to spend $100 billion in CapEx to do that, right? So I think that's a very, very rational decision. And again, Apple, higher valuations than the other Mag 7, but on a free cash flow basis, a little bit more attractive. I think Meta views this, right or wrong, that they feel like it's very, first of all, some of that CapEx that they're spending today is internal use for ad targeting. And if you look at the organic growth rate of Meta, it's been amazing. If you had told me Meta would still be growing organically double digit, not only double digit, but 20% this time, I would have told you 3 or 4 years ago you were crazy. But what Meta's kind of figured out is we can use GPUs to better target you, me, Justin, and with better ads. If we have better ads, better hit rates, more ads that are more relevant, people are going to buy more, and that's a great ROI. So on that part of the business, they're actually getting a great return. I think the question is, again, a year ago at this time, we would have had a conversation about Lambda being one of the top 3 kind of LLMs in the marketplace. And Lambda fell behind, just fell way behind. And we have kind of this super team, the Avengers or whatever you want to call them, that marks put together, and they're going to have something probably by mid-year, and we'll see if they can kind of get back in the with a solution there. They think that's really important to them. I'm not so sure that is as important to them as they think about. I think they're very, very far behind Anthropic, probably number one, Gemini number two, OpenAI number three today. Grok like way low on that list. So we'll see, but I'm not so sure it's as critical as they think it is to get that right. So again, the way I would think about Meta is like they're not idiots. If they can't, they're not going to spend $50 billion a year on trying to create a best-in-class LLM every year if they're not having success, right? I think if they wake up and they say, hey, let's just buy through Anthropic, let's just buy through others, let's go down the Apple rack. I think that will be the backup plan. I think that would be probably a good stock, good out from the stock. If they're successful and all of a sudden they have an LLM that can generate revenues from that, and that's impactful, that's also possible. I think in many cases, Meta is like a win-win, right? Either they revert to the Apple solution and CapEx goes way lower, that probably does well in that environment. If the LLM is really, really good, and it's in top three again, maybe that's a positive too. So I think Meta's almost from a risk-reward perspective, Matt is kind of well positioned.
When looking at the fund, it looks like the two sectors that are most overweight relative to the benchmark are one, healthcare, and two, utilities. And it'd be probably unfair to like paint either of those sectors with a broad brush and say this is the reason why, because it's more bottoms up. But if you were to try to summarize, capture the more positive thesis on those sectors, like how would you kind of bottle that up?
Sure, happy to do that. So let's talk about utilities first. So, I think for, 15, 17 years in this country, we basically had an environment where, power demand in this country was flat. It was flat as a pancake. It didn't grow at all. But, still utilities grew earnings 4 or 5% a year, fixing the grid, replacing kind of coal with renewables. But I think what's interesting is both because of reshoring, maybe a little bit because of EVs, but more importantly because of AI, you've basically seen growth rates for utilities really accelerate. I mean, I have names in the portfolio that we think will grow earnings between 9 and 12% for utility. That's just kind of unheard of. I mean, we think NiSource will end up growing earnings probably 11% with a 2.5% dividend yield. At 20 times earnings, that's very, very low risk investment. That seems like a great idea for us. That will grow faster than the market, much faster than the market with half the volatility and transfer discount to the market, right? So, but I think what's interesting about utilities is, again, this goes to the point of, let's look at it at a micro level, not as a sector basis, right? There are parts of the utility space that have wildfire risk. California's got wildfire risk. There are parts of the utility universe that are being impacted because of rising PJM pricing because it's an unregulated market. And that's kind of driving not reliability, but affordability issues, right? So we're not investing there. But you know what? And NiSource, when they're putting a data center in Indiana, it's $1 billion of savings for customers, $7 a month for customers. When you put Amazon's data center in there, they're going to probably put another data center in there in the next couple of years. That'll probably add another $1 billion of savings for customers. It's kind of the exact opposite of what's kind of happening in the PJM region, actually impacting my home state of Maryland. So, where's all these data centers going to go? They're going to go to places like Indiana that want them. They're going to go to places like Missouri. They're going to go to Wisconsin. They're going to go to Iowa. They're going to go to Texas. And, what are the companies that are best positioned to benefit from that and actually don't have affordability issues, right? So again, we look at a NiSource, we look at a CMP, we look at an Ameren, a PPO. We think those are pretty good investment opportunities here. And that will grow earnings almost probably double-digit, or either high single-digit earnings with a nice dividend, kind of get you a double-digit kind of total returns, very, very low. So we like them. Healthcare is different. Healthcare has been an area of consternation. We've had pressure because of administration kind of changes. but it feels like a lot of those headwinds are kind of getting into a little bit better place. We've had more, a little bit better feeling around how IRA is going to play out, the pricing pressures, the tariffs impacts. I think there's a lot more uncertainty around that. And so we think there's going to be a lot of biotechs acquired over the next 3 to 4 years in this mid biotech space, as big pharma is facing a $400 to $500 billion generic shortfall next 10 years. Yeah, they're going to just buy a lot of things. So we're buying a lot of companies that we think are great takeout candidates in that space. Biotech takeouts usually happen at 50 to 100% premiums to where the stocks are trading, and we think there's a lot of names that have really de-risked portfolios. So we're buying a lot there. We are buying things in life science tools because life science tools have been a kind of a tough space, but again, fundamentals seem to be inflecting there. We like the distributors, and we're trying. There's areas of healthcare that are really, really attractive. And again, healthcare has been a sector that's been out of favor. Again, we tend to go where the IRRs are the highest, and healthcare and utilities and parts of software today are probably some of the highest IRRs in the marketplace.
It's just with healthcare, if you think of like the aging demographics of this country and what people need for their health, it seems like, at least, if you want a job and probably if you want to do good investing over the next 5 to 10 years, it's like the demand is just going to be crazy.
It's a very positive demographic backdrop. And again, I think this biosimilar and generic pipe, that benefits the distributors, it benefits PBMs, it benefits all these small mid-cap biotechs. I mean, if you think about the two real powerful themes that we want to play in healthcare for the next decade, it's GLP-1s, because I think that is, GLP-1s are going to be the new statins. I think there will become a time that when the price points come down and we have more biosimilars and more options, I think half the population will be on GLP-1s because we know reduces the risk of death, heart disease, sleep apnea, diabetes, all these things. It's really kind of a miracle drug in many respects. And as the price points come down, I think the acceptance will go up. So that benefits everybody in that whole ecosystem that benefits from GLP-1s. And then there's just giant generic cycle, which again benefits distributors, benefits PBMs, benefits managed care, and benefits kind of mid biotechs, which need to be acquired for a farmer to take, to basically fix their pipeline issues.
We've talked a lot about the stock side of the portfolio, but what about fixed income? Like and I think you might have mentioned this before, but where are the attractive areas right now? And do you find, are you finding it like relative to stocks, is fixed income giving you like a good opportunity?
Unfortunately, very good question. There is less opportunity right now in fixed income because the reality of the world, the reality is that we are spreads are tight. Spreads are very, very tight. And then again, when you get kind of a speculative equity market, you tend to get a situation where, spreads get tight, and spreads are very, very tight today, right? So there's not a lot of opportunity today, as much as we've seen in the past in high yield, leveraged loans, as we've seen historically, I'd say. And again, I think when the 10-year got to 5%, we were buying a lot of treasuries. I would even say, the treasuries today, I think treasuries from our perspective, from a high level, look kind of fairly valued. If you think about the way we think about, just a back to the envelope way to think about treasuries what's the inflation rate? Let's call it 2 to 2.5% next 5 years. Add 100 bips on top of that for what Fed funds should be above inflation. That kind of gets you a Fed funds of, let's call it 3 to 3.5. And then add on top of that, maybe 100 basis points for the 10-year. Kind of gets you 4 to 4.5. And then we're basically right in the middle of that. So I would actually argue treasuries are kind of fairly valued today. I think that, but I would say the one thing, and we may have talked about this last time, is there's this negative skew to treasuries. And we believe that the most attractive part over time of the treasury curve is this, let's call it this 4 to 7 year bucket, the belly of the curve. Because in that belly of the curve, if you had a recession, you're still going to get a lot of benefit if rates drop. you're still going to get some appreciation of those bonds if you have a recession. But we do have an unsustainably bad fiscal situation in this country that will catch up to us someday. Do we catch up to that tomorrow, next month, next year, 10 years? I have no idea when the market starts to care about this stuff. But this idea of running 7% deficits to GDP is just unsustainable. It is an unsustainable situation that, I don't know, when does debt to GDP get to 150, 200, 250? I don't know what that is. No one knows what that is. There's no real historical precedent. But I think there are signs emerging. We saw what happened with Japan this year. We saw what happened to UK a year or two ago with rates. That the incremental buyer of treasuries at 10 years and 30 years today is a yield-focused investor. And I'd also say the last two market downturns we've had, treasuries have not performed as well as they have in the past, right? The 15 downturns before that, treasuries always rallied. In 2022, when the market had a downturn, treasuries underperformed. In the April swoon, yields came down, but then they actually went up. So if treasuries are not as good as a diversifier as they've been historically, the relative attractiveness of treasuries and portfolio goes down. So we believe the belly of the curve is more anchored to Fed funds, whereas the 10-year and the 30-year part of the curve is more at risk over time from debt sustainability concerns. So, right, if you look at over time, the spread between the 5 and the 10-year has been about 40, 50 bips. That's kind of the long-term average. We're kind of right there. We're basically right there. We're like at 45 basis points. Yes, I don't know where we are exactly today, but about 45 basis points, right? But if you ask me, are we going to go tighter? Or are we going to go wider over the next 5 years? Where's the skew? The skew is wider. It is more likely when we're having a conversation in 5 years, unless this country has done something about its deficits, we are going to be in a situation where that 5 to 10 spread will be closer to 100 bips or 125 bips over time. So long-term, historically, the belly of the curve is most attractive space, but there's this added risk today, this added skew that would kind of suggest also being in that kind of 4 to 7 year part of the curve is the most attractive part of the curve.
Well, and I think this might relate to partly to what you were saying about the level of our fiscal situation here in the U.S. But and I know you don't own gold in the fund, but I'm sure at the investment committee level, you guys have had discussions around it. And just, I guess my question is not necessarily like your outlook for gold, but like this, commodities tend to move like in multi-year, historically at least, like these multi-year moves where commodities do really well and really strong, and then they fall off the cliff and wipe out. But I'm just wondering, have you guys at the firm level, what is the house view, I guess, on commodities in general?
I would say again. I would say we don't spend a lot of time on gold because it is not an asset class we can really invest in. Mm-hmm. I would say, there's not a lot of market cap that's kind of tied directly or indirectly to gold. I mean, I think going back to my last point, the reason why gold is there's some speculative excess. There's clearly some speculative excess in the marketplace around gold. So I think that's one element. But there is another element that, again, that I think it is a way to express skepticism about the current financial debt unsustainability situation. That is definitely a factor for where gold is. Again, I have not spent enough time to tell you, is the fair value for gold 2,000? Is it 3,000? Is it 5? Is it 10? I don't know any more than I know is the right value for Bitcoin 120,000? Is it 10,000? Is it $1? I don't have a perspective on that. You are right. We, sometimes commodities go through, we had a giant bear market for 10 years and in energy, we had a bear market in energy from in 86, we do have multi-year periods of time, but I'm probably not the right person to ask about that because of that.
David, the conversations with you are always excellent. Thank you so much. We just have one. You already answered our 2 standard closing questions. So what we wanted to ask you today was, when a newer portfolio manager comes into T. Rowe Price, what are the biggest lessons that you and your, team try to teach sort of that new PM as they sort of get integrated into the firm?
I think the most important thing, and I've seen this time and time again, is you have to think that the best portfolio managers in my career think independently of the market. I mean, that means it's not like you can be aware of what's going on in the marketplace, but you have to trust your work. Portfolio, and I say portfolio managers who are always like chasing stocks that have gone up a lot and selling stocks that have been down a lot. You're like the last car on a roller coaster, right? You're buying at the wrong times, you're de-risking at the wrong times, and you're just you're chasing the market, and that is a recipe for value destruction. I think the other thing I tell people is you have to make bets. You just really need to make bets. I think I have found when we studied this that this is an industry that, unfortunately, historically speaking, you could make a lot of money being a portfolio manager in and be very mediocre because there are so many tailwinds in this industry. Right? You can be very, you have to take many bets. You can be very mediocre. You can still, and so I think there's still this like mindset of like, let's make sure I don't underperform, right? I think that if you don't take any bets, your odds out for the index are very, very low. You're not going to create a lot of value for your clients on a long-term basis, right? So I've always said your job is to find idiosyncratic, great risk rewards in the marketplace, take advantage of market inefficiencies, identify those market efficiencies, think independently of the marketplace, and if you can't just hug indexes anymore, right? It's just not going to work anymore. So again, I've seen portfolio managers over, and again, we've done a lot of analysis around this at an industry level. The people who hug the benchmark the most, their probability of underperforming is very, very high. It's extremely high, right? And again, I'm not built to hug the indexes. I think over my career, we've outperformed the equity market by 350 bips a year for 19 years. We've outperformed the fixed income market by 300 bips a year over 19 years. We've outperformed the 60/40 index by 253 bips a year over that period of time. I'm very, very proud of that. But you can never deliver that track record to clients if you're always focused on what was working right now, if you're always de-risking if the market went down, and you're unwilling to make bets in the portfolio, right? I think that's really key. I mean, the people who are willing to make really educated bets, people who are willing to think independently of the market, and people who do good work, their odds of success are very, very high. And people who are unwilling to do really deep work, people who are kind of chasing what's working and selling what's not working, and who are hugging indexes, their odds of success are very, very low. And they're not really doing their clients a service. And I think in many respects, some of the challenges our industry has faced over the last 20 years is we still have too many portfolios at an industry level that are doing the latter, right? Trying not to lose and not make bets and actually not creating any value for clients and driving passive flows over time.
Thank you very much, David. We really enjoyed this conversation.
No, great questions as always. I really enjoyed this. I love the hour format. Great questions.
Thank you very much. We appreciate it.
Thank you for tuning into this episode. If you found this discussion interesting and valuable, please subscribe on your favorite audio platform or on YouTube. You can also follow all the podcasts in the Excess Returns Network at excessreturnspod.com. If you have any feedback or questions, you can contact us at excessreturnspod@gmail.com.
No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of the firms of the hosts or their clients.